Hello to everyone. I'm hoping you're all fine and, like always, ready to take a course of today. So, we are into the revision course these days. This course has been planned to take the revision of the taxation course, which is being spread out over the number of legs. The first leg of this revision course, we already have had it a day or two before. And today we are into the second leg. Not many things we have done already in the first leg, which has set up the whole tone. And you people have experienced the way that I have planned that revision for you. It's such a nice way. Those questions, the series of questions, I would rather say, they have been chosen by taking into account that while working onto those questions, you get the chance to not just see me practicing the question, but also revising the most of the technical content. Itself in the first leg, I came to give you also a flavor of spreadsheet practice, where I was practicing, I was revising the course by working the questions. I did take a time to work one question on spreadsheet even from the side of income tax. That's right now what we are focusing on. So if I once again go and take you back to that page or pages of table of contents just to get an idea what we have finished it so far and what's going to be the agenda for the next 3.5 hours. If you were not there in the first leg, you should have taken the time by now to watch it, because each leg of the revision course is a continuation of the previous leg. The second leg of the course, because it's being planned on a day which is a working day, but in the evening, and the students, when they come into the course, they come into a course with a delay of some time by 15 minutes, by 20 odd minutes, 30 odd minutes. Understandable, because it's a working day and some they get free from the work a little late than usual, particularly on Monday. Not a big deal. They join into a course after 30 minutes or 15 minutes because they know that they can catch it up based on whatever they are going to miss, based on what they're going to miss from the recordings. I at least have to be there and present the course just to conduct it and complete it. So this is the list of those questions we have worked in the first leg. The question named Vigorous PLC, Vanessa Insane, the Bail, and Nastile. These 4 questions were worked. Lot many things were shared, lot many things were talked about in regards to the time management, guidance. The approach of solving the question was the top of the list talk, that how do you have to really answer a section C type question, the way that you have to leave a space for the main body of the question and followed by workings. Because it's a section C type question that requires to have all sorts of planning. Section A and B, they are objective tests. And if you have a knowledge, you apply that knowledge and work those questions out at your side in a rough manner and just come to click it or type in your answer into a fill in the blank. Examiner just comes to check your solution, just comes to check the option that you have selected and the option that you have fill in the blank for. In fact, not the examiner, it's computer marked. Section C is a type of a question that the examiner comes to mark and comes to see the solution of yours. And that is where the planning and the good organization of the question comes into play. With this, let's finally start the second leg of this revision course from the question named Sam, Tem, and Uma. This question will cover the partnerships. A topic of partnership we have done, and we all have got the idea from the regular courses of our that you may work the profits for a partnership business, you may work for the profits for the sole trader business. Profits are worked by using that same way. Just in the end, the profits are allocated amongst the partners within the partnership business, which in a sole trader goes to that one sole owner. So this is only where the difference comes in, that when the profits are calculated for a business, which can either be a partnership business or can be a sole trader, to calculate the profits, we take the same route, we take the same process, we apply the same rules. May it be a capital allowance calculation, may it be an allowed disallowed incomes and expenses, may it be a basis of assessment to assess the profits into tax years. Everything remains to be the same. No matter you work the figures for the sole trader business or for the partnership. What sets them apart is the allocation, which is a necessity, because in a partnership business, we have number of partners sharing their share in the business. So once the profits are worked in a partnership business, we come to give them their share of profit. That is called as allocation, which we don't do for a sole trader, because in a sole trader, there is a sole owner who takes the whole profit. This is what we're going to touch it in the question named Samu Tam and Uma, and we'll be able to revise whatever the best that we can by taking that one question on partnership. Landing myself onto a page that this question is on. This is on the page number 27. And the question has been divided into two parts. The first part requires us to calculate the income of trade, just the income of trade. They want us to calculate. For Sam, Tam, and Uma, then they want us to calculate the taxable income. So taxable income means that this income might have a trading income, this income might have a property income, this income might have a property or trading interest dividends. The question might tell us about some other sources of incomes also. So on top of trading income, we might have to top this with some other incomes. The question might provide us, like the question provides us with director's remuneration, the question provides us with the figure of salary also, the question provides us with the figure of maybe property income. You should indicate by the use of zeros of any items which are not taxable or deductible. So first concern is to work the profit of trade and assess them to their tax year 24 and 25, which is, I would say, is a main part that this question requires us to perform, is a main part. Let's go to read. Sam, Tim, and have been in partnership. So these two partners have been there since long. You don't see the inclusion of Uma in it as of yet. So actually, this partnership initiated by two of those partners, Sam and Tam. Preparing their accounts from that day, Tam retired as a partner. So Tam is moving out. Let me write this symbol with that, shows that this partner is exiting. Very important for us to notice the day of exiting. With Uma replacing the partner on the same day, the very next day, or you can say the same day. So yeah, that's the whole story. Uma is stepping in. So Tam is exiting, Uma is entering in. On the same day, the partner Tam has retired. The date of retirement is important. So you take that as 1st November or you take that as 31st of October, both they have the same meaning. Sam has always received 80% share of profit, with Tam and Uma receiving a 20%. So that's the ratio. Sam is going to take 80%. Tam takes 20, and when the Tam will go out and Uma will replace the Tam, Uma will start taking also the 20%. Got it? So 80% Sam takes it. The remaining 20, when Tam was there, was taking 20. Now when the Uma will replace the Tam, Uma will take 20. Because Uma is a replacement of Tam. So whatever the Tam was sharing it out, the Uma will continue to take that share. The same 80-20% ratio will remain in existence forever. And then they've provided us with the profits for 2 of those years. We will see how to allocate. Sam, Tam, and Uma. So they have provided us some other pieces of information also. But I believe this next reading is going to be served in the part B. Because in the part A, they require us to find the figure of trading income, which we have to find it out of this information, trading. Well, the rest includes some other income. We can still read it for tax year 4-5. Sam does not have any other income apart from 80% share. Tam, in addition to 20% share, was employed by XYZ PLC from this period of mark to this period and received the pension income of the following info is available. Yeah, so like I told you that this information is going to cater part B. Part A is about computing the trading income, which is out of this piece of information, we will be able to figure it out. Where the question requires us to find a taxable income, this taxable income then will involve some other income like employment income, property income, interest income, dividends income, for which they have provided some other sources of incomes in the respective section. So we will look into this entire thing a little while after. We'll put this on a hold and can focus only on this part to answer part A. Analysis is very important. Let me bring the board work of this question in front. The title of that one is going to be Sam, Tam, and Uma. Okay. So while I'm answering the part A, there are 2 of those years that they have mentioned. Year ended 30th of June 2024. Year ended 30th of June 2024. One 137500, and then year ended 30th of April 2025. The profits are 132,000. So rather we go and write them in this way. I can expand the whole of the years in front. So this is year ended 30th of April 2004, which will be starting on 1st of May 2023. This will be starting on 1st of May 2024. So when is the day the partner T is retiring? And when is the day the partner U is admitting, or you can say replacing, the partner name Tam? The day is important. Let's check the date, 31st of October, which looks to me falls into a second year, not the first. Are you observing with me? 31st of October 24 falls in it, not above. Falls in it, not above. So that means in the first year, we only have Sam and Tam. Sam and Tam in the first one. And I'll go and write the date of 31st of October 2024. How many months can we see before and after? There are May, June, July, August, September, October. May, June, July, August, September, October. We have 6 months to cater before and after. November, December, Jan, Feb, March, April. Yeah. So 6 months before, 6 months after. No, no, we have to look according to the year. So that is not April, that is June. My bad. Not as far as technical side, I just have copied the wrong dates and I'm correcting it. According to that, this is going to be July then. Okay, so it's July to June. It's July to June. Corrected. So this arrangement now will go to even correct. July, August, September, October. We have 4 months to have it before. That means after we would have 8 months. Those 8 months are November, December, Jan, Feb, March, April, May, June. Fine. So in the first 4 months, we would be having the Sam and Tam. But in the last 8 months, we would have Sam and Uma because Uma is going to replace Tam. This analysis is important because if you will not analyze this, later you will struggle in allocating. So when I will go to work the answer for the first year, I will be at peace since I will only have to concentrate on Sam and Tam. Let's concentrate. This is the first of the two of those years. You remember a chart that we used to prepare? A column of Sam, a column of Tam, and there we have a total of. So the profits are given as 137500. Sorry. 137500. We have to share 80% to Sam and 20% to Tam. 137500, the 80% of that. 110000. 110000 minus 137500. 27500. 27500. So the profits for this year have been allocated amongst the two of these partners with no admission of new partner or the retirement of old partner is happening in. But now when I will take myself down to the next period, I will have to divide this whole calculation into two parts. If you can recall that way, the way that I've done things back into courses, I will work the 4 months separate and 8 months separate. And I will repeat that pro forma, which includes all three partners. I will include now for the first time, Uma, and the profit for the first 4 months. What has been the profit of the whole of the next year? 132,000. The 4 months effect is going to be what? Multiplied by 4 divided by 12. That's going to be 44,000. 44,000. Profit still has to go to Sam by 80%. The 80% of that will be 35200. Tam will take the remaining 20%. But obviously in the first 4 months, the UMA will not take anything. I will repeat the work now for the last 8 months. The profit for the last 8 months are going to be 88,000. Now 80% still will go to Sam, which is 70400. While Tam will not take 20, Uma will take 20 this time. And this way we can find the totals under each of the side. Obviously, this side only will have 8800. This side will only have 1600. This way, the whole 132,000 has been allocated. The 35200 plus. So again, I'm reminding you of that if anyone who has been in a course and has taken the first leg and now into a second leg, or if someone will later watch the recording, my message is to everyone, whatever is happening right now, it's not being happening it for the first time in life. If you have got this thing coming into your mind, even for a single second, remove it out. In detail, in lot much patience, things have been done into regular courses in the past, and we today are trying to revise it by practicing those questions. And I'm adapting exactly same performers of working those answers so that that uniformity can be there, that connection to regular course explanations can even be made. That is the way of doing. You analyze it first. It all starts with analysis of yours. If you don't do it, you have made the mistake itself in the start. Because to allocate this into first 4 months and then into 8 is a result of this initial analysis. Don't do it, you will struggle or you will do all foolish stuff. When now I'm done with, I will go to assess them because they just do not want us to calculate. They want us to assess it in a tax year 24-25. The job is half done, not fully done. We just have allocated the profit. We have not yet assessed. Assessment now will come into play. And this is where I will come to make the use of the rules of assessment, where if you can recall, better for you, because then you enjoy the revision more. From the regular courses, if you can recall, two possibilities were understood. That if your accounting period coincides with tax year or does not coincide with tax year. Do you remember me using this word coincide or aligned with tax year? Now that debate has come into our way in the revision course, that if your accounting period coincides with tax year or does not coincide. And now we are in a case where the accounting period does not coincide with the tax year. This requires us to prorate some profits from this year. I will take it into my tax year, some from this. And now those number of months again will require to have another analysis. But this analysis will be performed according to the tax year of ours. So far, you have not seen me incorporating any tax year debate. Now I'm going to bring it in because assessment of profit is based on the tax year of yours, which we know that starts on 6th of April. 2020-24 ends on 5th of April 2025. Everything has a way. You cannot just take all the things at one place. While I was allocating the profit, I was never been concerned about it. Did I write this tax year thing once while I was allocating the profit? But now because I'm trying to assess the profit, so tax year will definitely come into play. For our comfort, I can come to write down these two periods again on that page for your better and better understanding, so that you can now with me easily analyze. So how many months of this year and the tax year of ours are in match to each? How many months? Looks to me about only 3 months, April, May, and June. So I can write this thing the very next. Now this analysis, you have to do it on the day of exam. I can explain this to you number of times. This comes to my way, I can explain that to you. Right now, I'm explaining it to you. But at the end of the day, you will be the one doing it all alone, setting it onto a day of exam. And it will require to have your analysis. It requires to have your analysis. So the best way to analyze is, you cannot be as sharp as I am, because if I have to analyze this, I can do that up in my mind. But because I'm conducting the course, so I usually come to demonstrate everything on this paper so that it becomes a part of your notes. Later, you download the copy of this file in a PDF and then you use it. So it has to have everything on. So I keep on writing everything. This way is the way that you have to adapt. If you're confused about, expand the dates of your tax year, expand the dates of accounting period, write them in front of your eyes, and then analyze. Just wait for 1 minute. Hold on for a minute. So the tax year of ours starts on 6th of April, and this period ends on June. I can see clearly the month of April, the May, and the June. These three are related. That means from this period, we are going to take the 9 odd months, and that we can count it from July 2024 all the way down to 31st of March 2025. Now I will use these months to work the profit of Sam and Tam and Uma. Can take the case of Sam on the first. So we've got the figures of profit of Sam from this side. This is from the last period, and this is from this period. So I will have to take 110,000. I have decided to take 3 months out of it. And I will have to take 9 months from 105,600. This will give me the answer that will go into a tax year of Sam. 105,600, 79200, 79220. So 106,700. 106,700. Now this is the figure that's gonna get into a tax year of Sam. I work the figure of this period first. I work the figure of this period after. And I have decided how many months do I have to take it from the first period? How many months do I have to take it from the second one? I've got to use a respective amount of profits to apply those 9 months, 3 months factor with that to get me to that. This amount is going to get into a tax year of Sam. Now I will do the same thing for Tam. The profit we have worked for this one is 27500. 27500, we will have to take 3 months out of it. 27500, 3 months out of it. And for this one, the figure we have is 8800. But this 8800 represents how many months? 4 months. Be very watchful. This 8800 belongs to 4 months. So when you are going to take something out of it, you will take 4 months out. And we have to take 9 months. So the whole of the profit of 8800 will come in because we are allowed to take the profit of 9 months. But these profits are only for 4 months. So that's the only figure we will take it the whole as. See, we have to take 9 months out of second period. But now in second period, when this partner only stayed out for 4 months, we will take the profit of whole 4 months over here. That's going to give us the answer of Tam. This, again, I'm telling you, is all about analyzing. If you don't analyze it well, you will struggle. 15675 is going into a tax year of Tam. Now, for the Uma, we do not have anything to take it from the last year. We do not have to take anything from the last tax year because the Uma has joined in when? In this very tax year, he has joined in. 31st of October 2024 is the date that he has joined in, which belongs to tax year 24-25. So how many months can we take it out? These profits are given for the profit of 8 months. 8 months. Again, requires to have your close look at it. This profit is a profit of 8 months. When he joined in, the day was 31st of October. And from 31st of October till the end of the tax year of ours, how many months can we take? We can take November, December, Jan, Feb, March, 5 months. So we have to take 5 months out of 8 months to assess 17600. 17600 multiplied by 5 out of it. So if you're confused, that means you're not still concentrating it on the analysis of which month we are working this answer for. and you're just focusing on calculation stuff. Means you at your side are not focusing on that. How did I get these 5 months? You probably are only using 5 by 8 multiplied by this to get this one out, but you're still not good on 5. If you are not, then it means you're not really realizing this whole analysis thing. You have to sit in a piece and watch it the way that you watch it. A movie with so much of your attention, or reels, or any random pictures on through social media, you try to zoom in, and you just concentrate it on the same that is required over here. No text rules are even applicable over. You have to check the day this person has stepped in. That day is 31st of October. And from that day till the end of the tax year, how many months to run? Count it. November, December, Jan, Feb, March. This is from where the 5 months have come into play. Because your tax year ends on 5th of April 2025. So you only can take 5 months of profits into this tax year out of 8 months of profit. So from where this 5 by 8 has come into play. And for UMA, you could not take any profit from the last year because the analysis itself shows that there is no UMA in the last 12 months. The reason why you could not see me taking anything from the last 12 months for UMA, but I was taking the same thing for Sam and Tam, because Sam and Tam, they have been in partnership since long. They had to take some profits from the last year, some from this to have total. UMA just have to take 5 months out of this tax year, and the calculation, because we have worked it out for 8 odd months. So when you're going to take 5 months, it will be 5 out of 8, not 5 out of 12. There I did not use any months. Again, can worry you a little. Why did we take the 3 months? The same story as Sam. But there we had applied some months. Here we are not, because this partner remained to be there till the end of the year. This partner has resigned, so we have to check the date of his resignation. The date of his resignation is 31st of October 2024. Means after 4 months, since the start of this tax year, 4 months. We have worked the profit of 8,800. And the same profit will come in to add in. Yeah, if calculations have been an issue, this is where you can correct me on. If calculation has been an issue, this is where you can come to correct me. But 4 months will come in April, May, June, July, August, September, October. 7 months. Now, we effectively have taken 7 months. The tax year starts when? 6th of April to 2024. And from that day till the end of, this is the day he has resigned. How many months are we going to take the profit of his? 7 months. Count it. April, May, June, July, August, September, October. So haven't we taken the 7 months of profit? This profit is for 3 months. This profit is for 4 months. This is the profit of 7 months. But this is the year the tax year of yours starts on 6th of April 2024. And the day he resigned, the day was 31st October. So count the number of months with me, 7 months. April, May, June, July, August, September, October, 7 months. So we were supposed to take the profit of 7 months. And that's what I have done. 3 months of profit from the last year. This is the profit of itself, the 4 months. As you can see, we have worked the profit of 4 months, 8,800. So it's nothing. It just requires to have your full involvement. And when you will do it by yourself, then you will be able to concentrate more on, because you actually will work this by yourself. Right now, you're just watching me doing. So you might not be pushing it hard. You're not giving your body and the mind a task to do it, because you are watching me doing that for you. Same as you do not get to understand the swimming unless or until you throw yourself into a swimming pool by yourself and fight it hard. And then you get to know how to swim, unless or until. You don't throw yourself into a pool. You don't get to taste the way of you, no matter how well the instructor is, how many times the instructor will instruct you on how to swim, you cannot get the taste of that by not throwing yourself in. That's what exactly I'm telling you. You're not watching me doing that for you, and you are finding it hard to really pay attention to it. But when you do it by yourself, because you have to do it, so you have no other way out, so you will do it with more concentration. But nothing is happening, it's just an analysis. You can see me being a lot patient on to, because this step requires to have being a lot patient. If I will just need to solve this question out, I would have written the solution and move forward already. But over and over again, I'm working on over to analyzing it. The first thing that I started off with the analysis, that in the first 12 months we only had Sam and Tam. In the next 12 months, at some point of time, when the new partner has joined in and the existing one has retired, in the first 4 months we had Sam and Dan. In the last 8 months we have Sam and Uma. This makes me to allocate the profit of first year amongst the two of those existing partners, 80-20 ratio. But this year was supposed to be divided into parts, 4 months separate, 8 months separate. In the 4 first months, you could see me allocating the profits down to Sam and Tam. In the last 8 months, you could see me allocating the profit down to Sam and Uma. After the profits were allocated, the next job was to assess. To assess, we need to find by how far each of the accounting year is in match to our tax year. So this exercise was performed, that 3 months by which this period is aligned to this tax year, this by 9 months. Sam, to assess the profit, I have been able to take 9 months out of it, 3 months out of it. That is the whole explanation of it. For Tam, I was supposed to take 3 months out of it, and this 4 months of profit was fully taken. Simply 8800 was as it, because the idea was to record the profit of full 7 months. For Uma did not exist in last year. So no point that you could take any amount of profit from that side to Uma. Uma will have to take the profit out of this balance. That balance we already had worked. This balance is a balance of 8 months. Do we have to take full 8 months? No. I have worked the analysis in front of all of you. The day he resigned, sorry, the day he stepped in, the day was 1st of November. The day was 1st of November. And till the day the tax year ends, there are how many number of months to count? 5. So only 5 months of profit can possibly be assessed in. When I was going to take these 5 months out of 8 months of profit, this fraction was worked. Can't explain it more better and more detailed than that. This ends up the first part for 8 marks. This is the reason why that this question has been taken for the allocation, the assessment of profits into tax years. The next requires us to find the figure of the taxable income. We can work this one out. Part B. Calculate the taxable income of Sam, starting myself off with the Sam first. And for this reason, I have to look into the facts that says, for the tax year 2004, Sam does not have any income apart from 80% share of profit. So the only thing that will go into tax year is gonna be the profit that we have worked, 106,000, because he does only have a profit with him. It does not have employment, does not have saving, property, any income. The only thing that he has is the profit of trade. And to make it taxable, you know that we do one thing. We come to subtract the personal allowance. And to subtract the personal allowance even at times gets revised. And you should not be forgetting that talk. If I go to bring that talk into the revision course, that talk was that when the ANI is more than 200,000 mark, then we go to bring the reduction. And ANI right now is 106,700, which is 106,700. So a little bit of adjustment on personal allowance is expected. That is the way that we have to go over to 12570. This way, the reduction is achieved. A and I, which is 10600 minus 100,000. We then go and take a 50% of it. This will bring the allowance down by what percentage? 6,700 divided by 2 minus 12570. It's 9220. So when the allowance has become this much, this is going to end the case of SAN. We will redo the same thing for the TAM. 9920 minus 106700. The figure becomes 96780. Okay. Now they want me to find the answer for TAM. For TAM, they've provided us with some other pieces of information. So we will see what those things are. They come to include, in addition to her 20% share of profit for the year, TAM was employed by XYZ PLC, XZQ, whatever it is, receiving a pension income in between to this. The following available for the tax year from 6th of April to 31st of October, TAM received a monthly gross salary of 3,400 from XZQ PLC. So employment income has come into play. So I can write it in the first place, the trading income as above. What is the trading income we have worked in part A? So you can make the reference of that part A. What is the income we have worked in the part A for TAM? The income is 15675, 15675, 15675. Here we will have to top it up in the figure of employment income. This we can work. This we can work by taking the salary into it, working. So this is the working on the same page we can perform. It takes on the first, the salary. The figure for the salary is 3,400 a month. How many months do I have to multiply this by? It all depends upon this number of months: April, May, June, July, August, September, October, 7 months. So when I will go to multiply this by 7 months, 30. 3,400 multiplied by 7, the figure is 23800. 23800. I will top this up in with the effect of the no, in fact, the pensions are contributed 5% of the monthly into. Yeah, we have touched the pension the other day on Venice and Syrian equation, where the occupational pension scheme, we have understood that it takes the deduction from the salary. You just go and take the percentage of the salary to try and bring this amount down. You see, there was a question we have done, although we have to spend time on the question of pension today, one question is coming to our way. But still, we have touched the pensions topic in one question already. The name of that question was Vanessa and Serene. This is how the way the occupational pension schemes are treated. They are deducted from salary. XPLC provided TAM with the interest-free loan. We also have done interest-free loan in one question in the first leg of revision course. Remember, vigorous PLC question. Car benefit, fuel benefit, accommodation benefit, beneficial loan, all benefits were revised in that. The balance of the loan outstanding was 6,400 and TAM repaid the full on 31st of October. Now that looks to me like a small loan, and small loan exemption becomes applicable when the balance of the loan turns out to be a balance at the start of a tax year less than to 10,000. This is considered to be as a small loan for this tax year, because when the tax year started, the balance of the loan was hardly 6,400. So it will be considered to be as a small loan, and small loan is exempt. So I will write it, the word beneficial loan, and can mark the 0 the very next to, because this is what they are requiring us to, that for anything that you're considering it to be not taxable, write it the 0th sign the next to. So main reason why that this question was picked was to explain you the partnership thing, which we already have done in the part A. This part B is just a formality that I'm trying to fulfill over here. 22610. After adding this out, I will come to subtract personal allowance to make this income taxable. 12570. This is it for the TAM. Plus 156. 75 minus 12570, 25715. So when you practice these questions from part exams, your mind opens up. And on the day of exam, you make yourself ready for it. Many students, they struggle to work questions on the day of exam because they do not make themselves accustomed to this way of answering. They have a technical knowledge, but they cannot apply that knowledge on the day of exam because they don't apply that knowledge to practice these questions in their life. And on the day of exam, they are exposed. This question technically is not tough, does not bring any new thing to us, but the way it has been tested, that to make yourself familiar to, you have to jump yourself in these days and practice. And for the day of exam, you become comfortable because you know which possible ways the examiner can test. You already have practiced all of those ways by working those questions out. It's a very simple thing that the students don't understand. And they fail the exam just because of lack of practice, lack of exam awareness, lack of the way of answering those questions, because of lack of practicing these questions. You tell me, what is so difficult in this question? What is so technical? What is so lengthy in it that can give you a nightmare? And if you're finding the time out to work this question, you will enjoy working it. And if you're done working, your mind has accepted this way of questioning and answering. And your mind will feel comfortable on the day of exam answering the same sort of a question. Last one is for Uma. In addition to 20% share of profit, this person was also being employed throughout as a marketing director. The following info is available. So paid a gross salary of 180,000. During the Uma paid an interest of 2,100 on a personal loans taken out to purchase her shares in a partnership. Now, this loan is called as qualifying loan interest because he borrows a money to purchase the shares in a business of partnership, which is called as a qualifying loan to him. And the interest on that will be a qualifying loan interest. That is it. So for Uma, I even have to prepare a pro forma of this kind by titling it as Uma, within which I have to top this up with employment income. Employment income will only have a salary to take, which is 180,000. I do not need to time or portion this salary because throughout the tax year, he was a director. So he was getting an annual salary of 180,000, which definitely I will go to add it as it is. Well, this is not really a working. Qualifying loan interest will take a place. For that one around, I can deduct the qualifying loan interest before personal allowance. The figure of that one is 2,100. This time, the personal allowance will not come into play. Ask me the reason why. Because the level of income now has become too big that when you will try to achieve that reduction, the way that I was trying to achieve that reduction for the SAM, this allowance balance will turn out to be a negative one. And in that case, we do not take any allowance. So the income that will turn out to be a taxable one will be the same as original income, 156,75 plus 180,000 minus 2,100. That's the end of it, 193,575. So you even can see at your side which part was more rewarding, which part was more important for us to work in a revision course. That part was part A. This question is over. Nothing is left further to look into it. I've checked it several of times. I don't see anything further in it. Yeah. So Sam had no income other than the profits from partnership. So for Sam, we just came to write the balance of profits. We have worked in the part A with the effect of personal allowance, and that's whole talk was supposed to be applied. We have applied. See, this thing is something that you can even make a blunder at it. In a continuity, on the day of exam, you might end up writing the 12570. And this is where the examiner is checking you on that. If you are able to make the use of this knowledge over here, and if you're not been able to, you will lose the marks. Who's going to tell you that you have to do it? Your understanding of topic, revision of that topic from the regular courses, and then from the revision. These things will tell you that, okay, you have to make the use of something so much important here. No one is going to knock a door. Look, go and do that. on the day of exam. Are you realizing what I'm talking about? This is the thing that you have to do it at your own. Each time you come across to the situation of personal allowance, this thing should start coming to your mind. Okay, do I have to reduce the allowance? Do I have to take that one as it is? So this ANI thing has to be more than 2, less than 2. This should start working the moment you are at the point of writing the personal allowance. This side I did not, because this allowance I have taken it because the level of income was too less to think me off about. I just came to take the allowance as it is. But again, the level of income when has gone bigger than 100,000. This had required me to think about it. But when I came to think about it, I have done the whole thing at the back of my mind that this is going to take me down to zero. No allowances whatsoever we can possibly use. The income will turn out to be a taxable income. So you only can be at you only can be able to apply it when you are first of all have mastered yourself on the rules of the tax and the way that we have done things in the past in the regular courses. Taking you back to the part A again, which is the main part for the reason why that this question has been taken for. The first thing in the question of the partnership comes in the allocation. And that's what I have done first. This is allocation. This is allocation. Then comes the assessment of profit, where if the accounting period coincides with tax year, your life is simple because this month's calculation will not need to be done. But when your accounting period does not coincide, then you have to do partially from this, partially from that, and that requires you to make the good analysis. 3 months, 9 months, that could have been 6 months, that could have been 8 months, 4 months, that could have been 5 months, 7 months. And then more difficult part in that, the one partner is exiting, the other one is joining. So you also have to check the dates of their retirement and admission also. Because things for the SAM were straightforward. 3 months, 9 months. But that was not the case with TAM and UMA, because we also had to respect the date of departure of TAM. Could have not just taken 9 months blindly, like the way I've done things for SAM. SAM or UMA got entered into business later. So could not just come to apply 3 months and 9-month factor with that. So see, this is where you have to make yourself good at by respecting each bit of it, by casually knowing each topic, but not to the extent that you can purposely solve the question to get marks out of it. There is a lot of a difference. Just casually keeping in mind that allocation, I know how to allocate and all, but not exactly the way that this needs to be done in a given scenario is a big difference in that. So we are over to it. Taking ourselves down to something else now, that's going to be the trading losses. I've planned to work 2 questions on losses, and these 2 questions are making sure that we are going to cover almost everything the topic of trading losses has to offer. The first question is named as Samantha. The second one is named as Michael and Sean. These 2 questions, believe you me, are going to cover everything into its arms from the topic of trading losses. So I will go to brief you on each of that loss relief one by one. After completing these 2 of the questions on the losses, we will straight away go down to the question of pension, which will go to have a detailed talk in regards to a topic of pension. Okay, let's go to read the facts to try and understand what they require from us to do, which page that this one is on, the page number 29. Yeah. State the factors that will influence the individual's choice of relief. So these factors, to make the list of that, can give you simple marks. But I will come to talk about these factors after, because when I'm going to solve the part B, you automatically will be able to answer it within, because I will be talking about that which way that we should have to relieve the loss. That planning itself will let you know about the factors that I have named, that this factor, this factor, this factor. So we'll go down to the part B. In the part B, they want us to calculate the Samantha's taxable income and gains for each of the tax years. On the assumption that to leave the loss of 81900 for this tax year on a most favorable basis. Now, this most favorable basis is in fact the basis that we can give us the benefit of tax, which is where I will go to consider a few factors, which itself will be the answer for part A. I can just list down those factors. But like I told you, when I will go to talk about those factors in part B, automatically that will be answered. For this reason, let's go to read the question. Samantha Fabric has been a self-employed manufacturer. Since 2012, she has been having the following incomes and the gains for the whole of the three tax years from 2020-23 all the way down to 25. Profits are provided. Interest, gains, chargeable gains do not qualify for business asset disposal relief. So we also plan to start off with the capital gains tax today in the later part of the course of today. So we'll talk about this BADR and the capital gains in the detail. But this question has given me a hint. If you are knowledgeable, you also probably have gained the hint that they want me to apply one section under which the losses are extended towards capital gains because they have provided us with gains. And I can recap. The first thing first, have to notice a tax sale. This is a loss tax sale. This is called as loss tax sale because this tax sale has got a loss in it, so we call it as loss tax sale. And they've provided me with the data next to that tax sale also. That means I can be having a chance of carrying the loss forward. They also have provided me with the data of the previous tax year. So that means I will be having a chance of carrying the loss back also. So by the look of this, I only will talk about those ways that this person can use, not all the other ways. Like there is a way that we can apply when only the business ceases. That's not the case right now. So I will not talk about that one section that applies only in a situation when the business ceases. I'm talking about the terminal loss relief. Remember, terminal loss relief is that kind of a relief that you apply on a terminal loss. And terminal loss equals to the loss of the final 12 months of the trade. That's not happening over here. So I will not be talking about the terminal loss relief in this question. We have another question for that. We will do it. Same, we have another option that we can go by, which is called as a relief in opening years. That cannot be applied even over here because relief in the opening years are applied in a question where the business has newly started. This business has started since long way back in. So can't think of applying that relief in opening years also. So why am I reading this question? Just to let me know, okay, which section I can think of applying it in. Two sections I already have filtered out. While carry forward section, still on, because I have a data of next year, so I can certainly carry the loss forward. I can have a data, I can carry the loss back to loss tax year and or one last tax year. There was a section that we have studied that can be applied also. Loss tax year and or one previous tax year carry back is only allowed. So that is definitely we can apply. And then under that section, we also can extend the loss against the capital gains of loss tax year and or previous tax year also. So like I said, if you are knowledgeable, if you have got this knowledge with you right now in a revision course, which you must have, then I do not know. If you don't have, then what you expect me to do? If I'm expecting to explain that to you, I will explain that. That is not the time you are coming into the course with the expectation of being explained, rather with the expectation of having a revision. So briefly, I can talk about those 2 to 3 possible ways that this person can make a use of. Roughly, I've already told you. Carry forward sections, definitely on. Current year carry back, definitely we can apply against the total income, against the chargeable gains. So let's go and pen down. We have to notice the tax year of the loss, which in this case is 23-24. Sorry, 24-25. 24-25 is a loss tax year. So the first option that I have is to carry forward. Carry forward to offset against, to offset it against the trading profits. Carry forward to offset against the trading profits of future tax years. Now, how many of those number of years we can carry the loss forward? How many of those number of years who can carry the loss forward? Infinite. Against the profits of, against the profits of trade. This section is automatic, but in order to establish the amount of the loss that we are trying to carry forward, one has to make an election, one has to make a claim by the end of 4 years, by the end of the loss tax year. Claim 4 years by the end of the loss tax year. So that means if the tax year ends on 29, the April has to be of 29. 4 years by the end of the loss tax. So quickly I have summed this up. This is the first option that they can think of going by. Against the profits of trade or future tax years for infinite number of years, the relief is automatic. But in order to establish the amount of the loss that they wish to carry forward, because not the amount, whole the loss they probably will be carrying forward, part of it. So that the part of the amount of the loss that they wish to carry forward, the claim is required by the end of that tax year, 4 years within. That's a revision of. So let me go and talk about the possible options they have. And then I will go to make a strategy that which option do we have to apply first and then so on. But two of the other options that they cannot go by, I will not even talk about. Like I already have told you, terminal loss relief, they cannot apply. Relief in opening years, you cannot apply. Option 1, option 2. So what is the option 2? The all popular loss relief against the total income. So this way I can write once again the loss tax year and can come to write. So here the losses are relieved. First of all, the claim date for that one is different. The claim date is 2 years within the 31st of January. 2 years within the 31st of Jan. So the 2 years within, it has to be 31st of Jan 2027. Yeah. The claim date for that one is 31st of Jan, 2 years within. Relief against the total income of lost tax year and or previous lost tax year and previous tax year. The sequence of relieving the loss is not a standard, is not a hard and fast. You may relieve the loss against the lost tax year first, against this tax year first, or against any of the two after. Applicable to this case, the lost tax year is going to be 24-25. The previous one is going to be 24-24, 23-24. So the sequence can be this sequence. The sequence can be that sequence. Only against this tax year or against only this tax year. Not necessarily both the tax years will have to be used. Any order can be. And this is where I will have to incorporate some points, some factors, which will make us to decide which way is going to be the most beneficial for us. This total income is the total of all income after qualifying loan interest, to mention that. That income, which is after subtracting the qualifying loan interest. Total income after qualifying loan interest. But this question, I don't believe we have a qualifying loan interest. But just to explain that, just to revise this, I said it. Claimed it, I also have mentioned it. That's the second option they can go by. Third and the last option that they can go by is to relieve the loss against the capital gains of the lost tax year and or previous tax year. So let me go to edit it. First of all, I will go to write that as a third option to go with. Then I will go to write instead of total income, I will write capital gains And more importantly, this is an option which we can only go by after making the use of section 64. This is an extension. Extension. This option is only to be used when we are done using that option number 2 first. Extension. I can write it in a way so that you can connect extension to option 2. So this is not another option. This is in connection to option 2, that when you are done using that option 2 and you still have got some loss left, that you can extend it towards the capital gains of the last tax year and or previous tax year. In its own isolation, this cannot be used. You cannot use it after bypassing option 2. Option 2 will come first. You're done using the option 2, loss is still left behind, that you can then extend it towards option 3. I mean, option 3 is exercisable only when you have exercised the option 2 on the way first. And that's what we're going to exercise it, because this question definitely provides us with the gains for us to apply that option. We will have to make the use of the option 2 first. While carrying the loss forward is just another way you may end up using, you may not end up using, that's totally gonna be the choice of ours. So after writing down all of these 3 options, at least I have revised 3 possible ways of relieving the loss quickly. Now let's see exactly which option we have to go by considering those factors. For this reason, we will have to prepare the body of the question first. I will write down the whole of those columns and we'll feed the figures into it, profits and all. So 3 tax years to write it in. The first column is going to be 23, 24. The next one is 24, 25. And this one is 26, 27. Starting to write the figure of trading profit. Two 1600, 81900, 11650, 11650. Then comes the building society interest. Five two 100, 3800, 1850. And then comes the chargeable gains. So we will have to write the chargeable gains with a bit of a space, because you can't add the chargeable incomes into the incomes. So you have to keep it separate, because chargeable gain is a capital income, where the rest of those incomes are revenue incomes. You can't add the both. But yeah, obviously we will use that same page to record, since we have to relieve the loss against the chargeable gains. Looks to me somewhere over here we can fit in chargeable gains with a gap of few number of rows. Okay, the chargeable gains are 53600, 53600. We have 9700. Then we have 12500. Okay. Looks to me we have copied everything except the loss of the capital needs to be considered. We will consider it. Here I can find the figures of the total income. I have not yet. Yeah. So the total income has even been found. What next? And this is where the factors will come into play. These factors are in fact the part A of ours. We still have to find the total. The total is 21600. 21600 plus 52100. It's gonna be 73700. 73700. This is 3800. While this planning point was shared to all of you in the past, and I'm still sharing it, that always to make the habit of leaving a space the very next to the profits of trade. As you can see me leaving a row, and do not find the total of the column next to loss tax year. You can find the total of the column of the loss tax year and the previous tax year, but do not dare to find the total of the column next to loss tax year. It even has a reason which has been shared in the past, and I'm repeating that. When you carry the loss forward, the carry forward loss relief is against the profits of trade. So when you are going to fix any of the amount of the loss over, this definitely will change. So it's a good practice not to even find the total of this column next to loss tax here, and wait for the time when the question is really over, then you can find. And because we have to fit in the carry forward section next to the profits of trade, so we leave a space for carry forward loss relief over, because that's against the profits of trade. Okay. Now we have two options to go by. Option third we cannot use unless or until we are not done using the option two first. So keep the option third into the last. The real tussle is in between option one first or option two first, or vice versa. Do we have to go by carrying the loss forward, or do we go and relieve the loss against the loss tax year and the previous tax year first? The major thing that will play a part in it is the level of income we have in the column of loss tax year, which looks to me quite a low. The first thing that you have to keep in mind that no matter which way you go by, loss relief will bring you a saving of tax. You may carry the loss forward, or you may carry the loss back. It will bring a saving of tax. But by carrying the loss forward, when the losses are carried forward, you end up saving a tax in next years. And there is no real benefit in it today. I mean, if today you don't get any cash incentive, because you will save a tax in next year, in future. It will be a future benefit, not in a real terms. Today you will get any benefit. Your cash flow will not be improved today, because that is expecting to save you a tax in next years. Got my point? But whereas when the losses are relieved against the loss tax year, and moreover you carry them back to the last tax year, you end up saving a tax today. It improves the cash flow today. As first of all, you will not end up paying the tax today because you have been able to relieve the loss against the loss tax year. So this tax year, you have no income that can be taxed. So you end up paying no tax today. The cash flow will instantly improved. And moreover, when you will go and carry the loss back to last tax year, all the tax years liability that has been paid already in the past will now be refunded to you as a bonus. So you all can make the sense of that, that carrying the loss back and relieving it against the loss tax here is always a preferred option over to carry the loss forward. So hence decided option two is going to be the preference of ours. And then after that, we will go with the option one. So we're not carrying the loss forward first. We are rather making the use of option two first, which allows us to relieve the loss against the loss tax year and or previous. So first factor is timing of cash flow. Timing. Future saving of tax or today's saving of tax. Timing. This makes me to decide to go with loss tax year and carry back section. That's the first factor you have to write it to get mark. Timing of cash flows is one of the factor that makes us to decide to not to carry the loss forward, rather relieve it by making the use of option two first. Now within option two, another tussle is within option two, we are allowed to relieve the loss against the loss tax year or against the previous tax year. Or we may relieve the loss against the both tax years. And that too in any order. That is another tussle with an option. Now, for this, we need to then keep an eye on the level of income. If the level of income in the last tax year is too low, which is the case right now, what makes that income to say too low? Sorry. Do we have to really have any threshold for it? The easy way to remember to say that this income is too low is to see if this level of income does not even match the balance of personal allowance. What is personal allowance? The limit of that 12,570. If the level of income is less than 2 personal allowance, that income is considered to be as too low, because this income will not be able to cover the personal allowance. Too low the income is, even we are losing the part of the personal allowance because the level of income is too low. Or in other words, even if I do not deduct a loss relief from here, I will still end up paying no tax. Why? Because this 3,800 will be exhausted by personal allowance. And the taxable income will turn out to be zero. And income tax liability will turn out to be zero. Getting it or not? So no point in using that income to relieve the loss when the level of income is too low that cannot even exhaust the personal allowance. You have to keep that income as it is. Don't touch it. Divert the loss down to last tax year, which I'm doing. And when we have diverted the loss down to the last tax year, when we have diverted the loss down to last tax year, when we have diverted the loss down to last tax year, you have no choice but to relieve the loss on a full extent, because you are not allowed to relieve the loss part of it. You have to relieve the loss on a fuller extent. Now, this time, don't say this to me or to examiner that we are wasting the personal allowance. You will waste it when you will apply the loss relief. You cannot save it from all the side. You will waste it. Are you understanding what I'm talking about? It cannot happen that you can make everyone happy around. You can try to do the best that can satisfy the most, but you cannot make everyone happy. Same apply to. In order to relieve the loss, you have to sacrifice the personal allowance from either of the two columns. If you have made the use of the loss relief here, you would have lost the personal allowance from here. You can't save it from everywhere. Preference is that the lost tax year income, if it is too low, don't touch it. Divert the loss down to last tax year and relieve it then. There you do not need to now question it a lot that, okay, what should I do now? Because if you will still go to plan this one out, you will never be able to make the use of option 2. You will never be able to make the use of that. So to make the use of that, the best strategy is to divert the loss down to the last tax year and relieve it. And the second incentive for me to divert the loss down to the last tax year is to extend it towards capital gains of the same tax year. Because I told you, option third cannot be exercised if you are not done using the option 2 on the way first. So it cannot happen that you feel it like, okay, let's not go and deduct the loss from this column also because I can deduct the same from the gains. That cannot happen. In order to stretch this loss towards the capital gains, that tax year's income must be reduced down to zero first, which has become zero. Fine. Then I can, because they want me to calculate a personal allowance, so I can make a room for, they want me to calculate the figure of taxable income. So it's better that we go and deduct the personal allowance so that we can find the taxable income afterwards, just to formally complete the question. Then I can now use the capital gains of this year to relieve the loss. What amount of the loss that have we are left if the total figure was 81900? 81900 minus 73700. The figure is 8200. So this is the amount of the loss that I can go to relieve it against the capital gains of the same tax year, 8200. So again, if I was solving this question, I would have taken like hardly 10 minutes to solve. I'm literally revising every bit of it from the loss chapter. This is the loss relief after extending it towards the capital gains. So to finalize the answers of that, we also have to look into the gains going into the next tax year. The losses of the capital will go down to the next tax year. Capital loss, or I would say brought forward capital loss. This comes to apply the knowledge of brought forward loss. The capital losses are brought forward, and we relieve them against the next tax year's capital gains to the extent that they should not waste the annual exemption. And the current annual exemption is 3000. That from this column, I will subtract. From this column, it's going to be a waste. From this column, I can write in advance so that whatever the balancing figure of the loss that we can fix it and we can fix it. The figure of the loss was actually 9700. For the capital loss. So when I go to carry it forward, I will go to carry it forward to the extent that it should not waste the exemption. So for that reason, the exemption, I have been able to write it first. So the amount of the loss that I can fix it in is a 9500. Is it 9500? Yeah. 12500 minus 9500. Still, we have 3000 for this year's exemption to cover. So this is 53,000. Sorry. 53600 minus 8200 minus becomes 42400. 42400. Okay with that. This I can finalize also. This column will have 11650. 11650 plus 1850. It's 13500. Okay with that. Too much of a hardship when one has to revise the technical knowledge, not just to solve it. Because if I was just solving this question out, I would have just solved it because I can just solve this question in like 10 minutes. But I first of all have given you the whole quick recap of each possible option that this person can apply, and then we've applied it. See the way that we've applied. The planning that we have considered is the number one factor is the timing of cash flows. The second factor was the wastage of personal allowance. Because this was too low that it was hardly be absorbing a personal allowance. So I came down to hold this income at its place so that the personal allowances can take the space. And the third factor, which we do not consider it a lot, but still a factor that at some point can be considered, is the rates of taxes. Because it can happen that the person pays the tax at the rate of 40% in this tax year, 20% in this tax year, or 45% in this tax year. So that can be another factor which we do not consider a lot as far as our exam questions are concerned. Practically speaking, it can be another factor which can be a reason of choosing which option to go by. But the main reasons are the timing of cash flows on the top of the list and the wastage of personal allowance. Okay with that? So loss, we have relieved it against this tax year first and then against this. And in the end, the whole of that. Now, within that, the capital losses are also being examined. So when you carry the loss forward, you just don't carry the loss forward. You also have to try and look for that the annual assumption should not be a waste. So the idea was to write this in advance so that we can fix in the balancing figure. That's from the capital gain side topic. Okay. Another question now we are going to get in, and this question will go to cover the rest of the options that the individuals can use. The question is named as Michael and Sean. It's pronounced as Sean, not seen. It has two parts in it, part A and B. Okay, and looks to me part B is a main part. Why don't we look into a part A afterwards? We'll start off with the part B first, Michael and Sean. And looks to me they have asked for the Michael separate and Sean separate. Yeah, they've provided us with a separate data of both, separate data for Michael and Sean. For each of the two of those taxpayers, Michael and Sean, identify the loss relief claims that they are available to them and explain which of the available claims would be most beneficial to them. So I'll start off with the Michael first. Part B, and within part B, the Michael. And for that reason, obviously, we have to read it first. So Michael started in self-employment on 1st of July 2023, preparing the accounts to 5th of April. His results for the first two periods of the trade are as follows. Okay. Trading loss and profit. Then they've provided us with the past data. This has been the amount of income that he has been having it in the past from the employment. Michael did not have any income during the year from 6th of June to 2022 to June 30th, 23. Okay. Because the Michael has just started, and this has suddenly given me one important clue that this question requires us to apply that relief in opening years. And I can first of all give you the recap of that. When can we apply this relief and how we can apply? As far as the assessment of profits and losses are concerned, this profit is going to be a part of 23-24 tax year. And this will go to be a part of 24-25. Because the accounting period of Michael is aligned with the tax year. So the day the accounting period ends on, the same day even the tax year ends on. So it becomes very easy for us to assess. Remember that for partnership, you can see the problem that the whole thing was creating, that the period of accounts were different from the tax years and we had to prorate. When the accounting periods are ending on the same dates, the tax year even ends on, and the accounting period becomes your tax year becomes your accounting period. Assessment becomes so easy. You just have to come and label it like I did. No months calculation is required. So in total, we have like 1, 2, 3, 4, 5 tax years to list them up. Like I've done the Samantha question. And lost tax year is 23-24. So to understand this one out, I can stick to that way. If the lost tax year is this one, which option they can exercise? This is called as first tax year. Since the start of the trade, this is the first tax year of the trade. First tax year of the trade. First tax year of the trade. So by when can we opt for, sorry, I will have to first of all make the title of this relief. The relief that we can apply in this given situation is relief in opening years. Relief in opening years. Relief in opening years. Relief in opening years. Okay, when can we apply the relief in opening years? When can we apply? How can we apply? How can we apply? When can we apply? So this relief is applied in only the first 4 tax years of the trade. 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 Are you listening? First 4 tax years of the trade. Since the commencement, obviously. And the claim date for this one is gonna be the same as above. 2 years within the end of tax year, 31st of Jan. So the claim date is gonna be 31st of Jan 2026. 2 years by the end of the tax year. So if the tax year ends on 24, the Jan has to be of 26. How to apply? It will be relieved against the total income of 3 tax years. Total income of 3 tax years. According to my question, that's going to be 2023, 21, 22, and 2021. Yeah, and the sequence of relieving the loss will be first in, first out. First in, first out. Relieving the loss against this loss tax year first, then this, and then this after. Total income is going to be the same as above we've talked about after QLI. Same as above. This is this section for all of you. So the question provided us with the data of the previous 3 tax years so that we can relieve the loss against the total income of previous 3 on the first and first out basis. But this section can only be used when you make the loss in the first 4 tax years of the trade. So let's go to check in which tax year did they make the loss in. In fact, the very first period of the trade that they have made the loss. So I've mentioned this to be as the first one. That means this section is pretty much on. And that's what we will go to apply it. And that's why the reason why this question was picked in to revise this section. Could have not been applied this in Samantha. Samantha was in trade since long. This business has just started. Have to apply it. So revised it, and now we can finally apply it. 5 number of columns do we have to prepare? 5 columns. 1, 2, 3, 4, 5. No, in fact, this 1920 is not required because the scope is going to be 2021, 21, 22, 22, 23. Yeah. So we just have to write the first one, which is going to be 20, 21, 21, 22, 22, 23, 23, 24. But this 23, 24 is one extra tax year. They have not provided us with the data of that even. Is it? So let's feed the figures 17200, 17200 in this column. 51,000 in this column. In 22-23, we have no income to write. This is the tax year of loss. The loss is 24600. And the next is the year of profit, which is 7100. So that's how the way this pro forma looks like now. This is trading income. This is employment income. And there we will find the total. 17200, 51,000, a loss. This is called as total income. And this how the way the loss relief has to be applied. We will relieve the loss against the loss tax here. These tax years are in the scope. We have to start relieving the loss against this tax year first and then this after 17200, 17200, 17200. The remaining we will have to subtract 17200 minus 24600. It's becoming 7400. So we are over to it. Nothing more needs to be done in it. That sequence we have to follow. No planning is required. See, when they have given us a sequence we have to follow, we will have to follow. So no such planning by ourselves this time is required. Have to relieve the loss against this loss tax here first, then against this, and then in the end from this. Good with that. This is the first most tax year of the trade. This comes to be the second one, third and fourth one. This can still be used if you make a loss either in the first 4 tax years of the trade. How beautiful that this question is, that this has covered up yet another option. And the last option we are going to apply in this last part, the name of which one is Sean, has been in self-employment since 2013, but cease the trade. So with the cessation thing comes into play, the moment that the word cessation has come into play, you have to suddenly start thinking of terminal loss relief. And the loss in the last 12 months of the trade is in fact called as a terminal loss. So I can call this one to be as terminal loss. He has always been preparing accounts to the 31st of March. His results for the final 5 years of the trade are as follows. So each of the tax year, Sean also have got a property income of 12570, which will be exhausted by personal allowance. Okay. On the top of the list, the name of a party, Sean. And then the same as above, I can write down the loss tax here right now is which one. So if I go to assess these profits and the losses into tax years, that's going to be assessed in 24-25. And all of those periods are consecutive to each. So tax years are also going to be consecutive. 2021, 21, 22, 22, 23, 23, 24. So 5 columns are required. But the loss tax year is at least 24, 25. So let me write it. This is loss tax year. So in fact, I will also be calling it to be as last tax year of the trade. So when can we apply and how can we apply? So when can we apply terminal loss relief? The answer to that is last tax year. Last tax year. How can we apply? How can we apply? So we relieve the loss against the trading profits, not against total income, trading profits. Trading profits of 3 tax years. Trading profits of 3 tax years. These three tax years are going to be 23, 24. 23, 24. 22, 23 and 21, 22 on last in first out basis. Against this tax year first, then this and this one out. Trading profit. Claim date of this one is 4 years by the end of the lost tax year. 4 years by the end of the lost tax year. So if the tax year ends on 25, the claim date has to be 5th of April 2029. 4 years by the end of the lost tax. 4 years by the end of the lost tax. 4 years by the end of the lost tax year. So if the lost tax year ends on 25, the claim date has to run till 5th of April 2029. Last tax year of the trade, this can be applied, which is the case right now. And how to trading profits of previous 3 tax years on the last and first out basis. This is where this last one section has come to its end. Check the way that these questions have been chosen to complete all of the revision in regards to the loss. Now I can just go to apply the discussion over to this question. 5 columns do I have to prepare, starting myself off with the very first column, which is 2021, which is 21, 22, 22, 23, 23, 24, and 24, 25. Have to paste in the data. The profits are given 21300. It's 14400. It's 18900. It's 3700 and a figure of the loss, which is 26700. So this is where we will have to apply terminal loss relief. Have to relieve it on a full extent, 3700, 18900, 3700 plus 18900 minus 26700, the figure is 4100. There you go. 14400 minus 4100. The figure becomes 1030. We're over to it. So there's nothing being left from the losses that could have been done in revision course as we have done it for. Samantha, the question that we have done has taken 3 sections in: carry forward section, relief against the total income of lost tax year and previous tax year, relief against the capital gains of lost tax year and previous tax year. This question, the Michael has taken the relief in the opening years, and the Sean has taken the terminal loss relief. And based on these 2 questions were planned, I will do the part A of it. We have gradually revised the whole of the knowledge of losses and being able to apply. The UK government uses the tax policies to encourage certain type of activities. Briefly explain how the UK government tax policies encourage individuals to save, individuals to support the charities, entrepreneurs to build their own businesses and to invest in some plant. Very general question this one is. And see, when I'm going to answer over to this part, you will be able to connect yourself to, because it's from the knowledge of the text that you already are aware of. So if I'm working the part A now, in the part A1 specifically, part A1, so I can use the same statement, UK tax, UK government, or I would say HMRC, uses the tax policies to encourage individuals to save by investing. A lot of investments are there for them to invest in and they end up paying no tax. Like they can invest in um, exempt investments such as individual savings account and national savings certificates. We know that these two investments are exempt. So if they hold their investments in these two, they end up paying no tax. So the authorities, they encourage them to invest in so that they end up saving a tax. Or they can also invest in registered pensions. And there are two registered pension schemes. The one is called as occupational pension plan. The second one is called as personal pension scheme. So when they invest into those pension plans, they end up getting the benefit of tax, and you know very well what benefit of tax they do get out of it. Or they could simple invest in bank and building society, taxable investments, such as building society. Building society interest is taxable, and so is the bank. But still, what is the incentive in investing in these two? Let me tell you all. Remember, we have done in the past savings NRB up to £5,000, starting rate band. These are two of those incentives that they will have from investing into bank and building society. Savings NRB, £1,000 if the person is a basic taxpayer, £500 if the person is a high taxpayer. This incentive is not available to any other sort of investments. And starting rate band, that up to £5,000, the rate of tax is 0%. Now, whatever I'm writing it over, it's not new to any one of you taking the course, but you just have to channelize it to get you the marks. We have just fulfilled the first requirement. Now getting into the next one, individuals to support the charities. So I can use the same statement as above. HMRC uses the tax policies to encourage individuals to support the charities, So what is an incentive in it, in supporting to a charity? Apart from your good deeds will take you to the heaven, to a paradise, the God will be happy. Apart from, what is an incentive? Living it on a planet, as far as tax side is concerned. We've seen that while you support a charity under gift aid scheme, remember that gift aid payment, there is a saving of tax. So if you participate or if you make a charity under this scheme, you end up saving a tax, not in any other charity except this. And the way that the tax is saved, we've talked a lot about this thing in the past. Even we have done the question on the other day on a spreadsheet, bail, where the gift or donation came to our way and I was revising the band limits by extending it. You don't get this extension thing in any other charity except the gift aid. So we have to name it. Then payroll deduction scheme, which comes under the banner of employment income. Under payroll deduction scheme, you ask your company to deduct certain amount from your salary and pay to a specified charity. So each time when you get your salary is net of tax and net of that charitable giving. This is something that we were supposed to write it in. Now, the last thing is that entrepreneurs to build their own businesses and to invest into plant. What is an incentive in me in establishing my own business? What incentive do I get from the tax because of that? That is what we are supposed to write. Being an entrepreneur, what is an incentive to me today if I go to set up a business or invest into a plant and machinery? What sort of incentive I will be entitled to? This is what we are supposed to write. So HMRC uses the tax policies to start a business by investing into plant and machinery. The first one is when the business is disposed later on, it attracts BADR, Business Asset Disposal Relief. That is an incentive to an entrepreneur who starts a trade, and the day the trade comes to finish off, that day becomes entitled to a business asset disposal relief. That's an incentive to me in setting it up a business. Secondly, the plant and machinery, they are entitled to tax depreciation throughout. Isn't it incentive to me or not? By investing into plant and machinery, AIA, 100% of the value of the plant is written off in the year of investment. 100%. AIA is available at 100% up to 1 million pound. So when the investment is done in the year of investment, 100% of the value of investment is written off as a capital allowance. And when it is written off, means expensed out to profit, the profit eventually is reduced, which brings a saving of tax. So it's that kind of a part which requires you to think out of the box. Not typical questions that require you to just calculate. But whatever I've answered, it's from the boundaries of this taxation course. Nothing I have named it that you have not seen it ever in the past 4 months. But a kind of a question that requires you to be expressive about by using the knowledge that you have, you will get your marks on it. That is what was being asked. That where to invest in so that it can get an individual back a benefit of tax. So start thinking of those investments, those are totally exempt. ISAs and certificates are totally exempt. Investments into pensions, registered pension schemes are exempt in a way that you invest into pension schemes. Eventually, when on the date of retirement, you receive a pension, that becomes tax-free. Even you invest into taxable saving income like bank interest or a building society interest, but they give you back some incentives in a shape of NRBs, starting rate bands, which you do not get to see it in some other incomes like dividends. That do not have any savings, the starting rate band. But dividends do have NRBs, but dividends do not have that starting rate band, which you get it on savings income. Charity is the moment the word charity has been used, start thinking of charitable donation like gifted donation, payroll reduction scheme. And what incentive do I have to establish my own business? The incentive is only have that later when I will go to sell off my business, I will be entitled to BADR, Business Asset Disposal Relief. And over the life, I will get the capital allowance, which in the first year of investment is 100% of the value of the investment. And over the life, 18% written down allowance or first year allowance. Numerous types of capital allowances we have seen. They definitely is a benefit to an entrepreneur because the capital allowance is a reduction against the profits. So they bring the profits down. Profits, when they go down, you end up saving a tax. We are now getting into the last question of the section of income tax, as we need to head towards to capital gains tax side today itself. And this question solely is going to focus on one thing. That one thing is pensions. So far, we are into a second leg, and more than the halfway through we are in. Apart from pension, you can think of it that any topic that we have not touched from income tax side. Randomly, start recalling the topics of income tax in your mind and take any name out that I have not touched into the revision by taking those 7 questions already in, because 8-1 is going to be on pension. 7 questions we already had worked. These 7 questions have made sure that almost everything from the income tax syllabus is revised. Some topics have been touched more, some have been touched less. It depends on, again, the actual weightage of this topic of in exam, because trading income tends to be tested a lot in exam. Employment income tends to be tested a lot in exam, but like NICs, but like partnerships, they are tested not as for big number of marks as the other topics are. Losses, we have completed everything in the topic of losses. Hardly we have left anything from the side of the losses. Pensions is the last one effort. Let's do it by taking the whole question of its own. Page 33, we will have to be on and work this question. I will give you a quick recap of this topic first, and then we will start applying. And Basil and Clove. Okay. For each of the three of those taxpayers, and Peach, Basil, Plum, and Clove, state giving the reasons amount of PPS that will have to be qualified for the tax relief for the tax year 24-25 and calculate their income tax liabilities for the each of the year. Okay. Tax implications for both the Basil and Banana Weeks PLC for the making the contributions into Basil's personal pension scheme. Implications of Basil's available for annual allowance, contributing £1,000 instead of 5 into Basil's personal pension scheme. So we will look into this in a while. We have got 3 persons involved, and Peach, Basil, Plum, and Clopier. You are training accountant, and you are asked by your manager in regards to 3 of those taxpayers who have made PPS. So this question is solely focusing on PPS. Okay. So before again, I will get into that, I will give you a quick recap of how the way the pension plans are. So this is an individual who, when comes to participate in a plan, which can even be a pension plan, just wait for 1 minute. Okay, so when individual participates into a charity, may the charity is an occupational pension scheme or a PPS one, both are registered pension plans. OPS, I can use the word registered. If the individual is having an age of less than 75, and the person is a UK resident, individual gets the tax benefit. So how this relief has to be applied, that's what we are going to learn. The disparity has to be a registered one. May it be an occupational pension scheme or a personal pension scheme. The age of the person has to be less than 75. The person has to be a UK one. The tax relief will be applied. How? Let's take the explanation of that. The first thing that we should be knowing that the amount on which the tax relief will be applied, amount of contributions, the gross one, on which the tax relief is available, we will have to take the lower of two things. Because not all the contributions that one participates in can give him a benefit of tax. Part of. Because one can participate £1 million in a fund, £2 million in a fund, with the hope of getting the benefit of tax. But not all what he has participated can give him a benefit of tax. So we've tried to put a bit of a cap over to it. Lower of two values, the gross contributions and the maximum annual amount. Maximum annual amount takes the higher of two values. £3,600 and the relevant earnings. £3,600 and the relevant earnings. Relevant earnings, there are three relevant earnings. Three earnings, those are relevant to the topic of pension. The first one is the profits of trade. Second one is employment income. And the last one is profits from furnished holiday lettings. Profits from furnished holiday lettings. This discussion is applicable to both the plans. May the plan is an occupational pension one or a PPS one. The calculation of amount, the process of that is applicable to both exactly in the same way. Exactly in the same way. Provided the amount is worked, how the way the relief is applied. Method of applying the relief. So this is different for both. Amount calculation takes the same process, but the method of getting the benefit of tax takes the different process. So I'm going to write the word occupational pension scheme and personal pension scheme. For OPS, the first thing that you need to remember, the contributions are gross. Contributions are gross. Here the contributions are a net of 20% tax. The contributions are net of 20% tax. That's the first difference you have to respect. The contributions are net of 20% tax hit, the contributions are gross. Whereas for it becomes a deduction from salary. And here the band limits, and we've done a question yesterday uh, in a first leg of revision course 2 days back, where Vanessa and Serene, one party was contributing it into pensions, and you people had seen me extending the band for that party. And for the other party, I was deducting it from the salary. Band limits are extended, and the liability computations are then based upon. Band limits are extended, and the liability computations are based upon. And this is what we will have to apply in this entire question. One more thing will come to our way on the way after we will come to apply, which is called as annual allowance charge. I'm wanting to give you the knowledge in the first go, and then we will apply this peacefully to the question, the facts of the question. The annual allowance charge arises when the combined amount of combined contributions, the gross one, combined amount of contributions, the gross one, combined, when I say, I mean to say employee plus employer. They exceed over to that 60,000 pound. For tax year, this limit is fixed. Excess becomes taxable. Excess becomes taxable either at the rate of 20%, 40%, or 45%. Either at the rate of 25, 20, 40, and 45. And we will go to apply the same story in it, within which also I have to come in, add one more thing, that this limit is 60,000 is fixed for this tax year, but this can be revised just the way the limit of annual allowance is revised. I can again write down the rule of a law, and then we can in a one go apply all the knowledge to it. Basic thing is to understand is this treatment, that how to calculate the amount in the first place. When you know how to calculate the amount, then how to make the use of that amount in getting the relief for PPS and for OPS. This is one extra feature into it that might be tested, might not be tested. It's an add-on feature. You have to take the combined amount of contribution, employer both, gross one. And any figure that you have found out to be a figure more than to it, that excess becomes taxable at the rate of 20, 40, 45. Depending upon at what rate currently he pays tax at, we will go to apply that rate. This limit 60,000 is fixed for tax year 24, 25. But in two possible events, it can be revised. Adjustment number 1 and adjustment number 2. There are two events of adjustments. We will have to adjust this within. Adjustment number 1, adjustment number 2. Where the ANI is more than 260,000. If that is the case, you will write down the limit, which is 60,000, and then you will go to reduce it by the effect of 260,000 minus ANI, and then you go and take a 50% of it. Whatever the answer that we have worked, it cannot fall below a mark of 10,000 pound. This is the minimum we have to take. Means if this balance has turned out to be 7,000, in that case, we will have to take a minimum of 10,000. The reduction can go to touch the bottom, and the bottom is 10,000. Can't fall below to that mark. So we will apply this probably the whole of the talk in a while. Then unused annual allowance from the previous 3 tax years is carried forward. Is carried forward. Any allowance which in the previous tax years have not been used, you will accumulate it and will bring it into this tax year on a first in first out basis. So this is going to be another talk in this question we will have to apply. How will this be applied? You will see. So any of that allowance in the past 3 tax years that have not been used, you will keep a good track record of it, and then you will go to throw it into this tax year to top it up into 60,000 of this tax year. So this might not be tested, this might not be tested, or this might only be tested, or this might only be tested, or neither of the both are tested. Just a 60,000 you have to use, which is a standard limit, or this entire topic will not even be tested because everything has got a criteria to satisfy. So this topic will only become applicable when this in the first place is happening. If the combined participations are less than to this amount, then this discussion will only be invalid. So like I told you, it's an added feature which might be tested, which might not be tested. Knowledge wise, I have given to all of you that knowledge in the regular courses. Today, I even have given you a quick recap of it. And now we can finally apply it by reading each case into it, starting myself off with the N Peach first. N is a self-employed as an estate agent. His profit or her profit for the year ended were 38650 and received an inheritance from an aunt in October 24 and used to make it a contribution of 42,000 pounds into a personal pension scheme in November 2024. Okay. So needs to be clarified. How will this go? So I will go to apply this knowledge to N Peach first. And this thing I will have to copy and paste this way of finding that amount. Rather to rewrite, we can go with that. So he has been participating 42,000. This amount is already given a gross one, so we do not need to double gross. This is the level of income that this person has, 38650. So I will write this thing 38650. Selection is based upon by picking the highest of two. 38650. Selection is based upon by picking the highest of two, which is 38650. When I will go to write this amount up there, 38650. Selection is based upon by picking the lowest of two. So once the lowest of two we have chosen, the figure has turned out to be 38650. 3650. Now, this is the amount with which the extension of bands will take place. 38650. Sorry, 38650. 125140. But 38650. 38650 plus 37700. It's 76350. 76350. This is 125140 plus 38650. The figure becomes 163790. 163790. So once the band limits are extended, the liability computations are based upon this person will have an income of 38650, income 38650. I will come to subtract the personal allowance, which is 12570. The income will become taxable. Once the income has become taxable, 12570, 26080. And income tax liability 26080 at the rate of 20% becomes 5216. So story of this party has come to its end. This party cannot expect to have an annual allowance chart because the contributions are way less than 2. This is the amount of participation has been made, which is definitely less than to that 60,000 pound. So we did work the amount like we normally do. With that, the band limits are extended. The liability computations are being then based upon. Then comes the claw pair. I will take the claw pair on the next. Then in the last, I will focus on the basal plum because basal plum is going to be the main thing in it. So I will redo the whole task that I have done for NPeach. We'll work the amount. Claw pair lets out an unfurnished house property. For the tax year, her taxable property income was 24550. Claw made the contribution of 8200 into a personal pension scheme during the year. So this is the participation that he has made. And his income from property was 24550. And this is not relevant. So relevant income is 0 because relevant earnings will take either profits of trade, employment income, profit from furnished holiday lettings. This is property income, and property income is not relevant to the topic of pension. So selection is based on by picking the highest of two, which is 3600. Here the selection is based on by picking the lowest of two, which is 3600. With this, the band limits will extend now. See, the whole process is revised. 37700 plus 3600, the figure becomes 41300. 41300. Then comes 125140 plus 3600, the figure is 128740. 128740. So when I will go to calculate the liability for this person, it will simply be worked by the same way as above. The level of income that this person has is 24550. 24550. 24550 minus 12570. It's 11980. Income tax liability at the rate of 20%, 2396. So process repeated. And this person again is not eligible to have any annual allowance charge because the contributions are way less than to that 60,000 pound. But Basil Plum is a third person into it, which will take everything into it. Basil is employed by a Banana Bank PLC as a fund manager. On 6th of April 2020-24, Basil received a significant proportion and the large pay rise of 160,000 pounds, such that in tax year 245 he had paid a gross salary of 262,000. Basil made the contributions into PPS totaling 30,000 pounds during the tax year. Now they've started providing us with the data of past years participation because they probably want us to apply that carry forward of the past 3 tax years annual allowance. So 30,000 was participated in 21-22 tax year. 40,000 was participated in last 2 tax years. Whereas during the tax year 24-5, he also made a gross participation of 60,000 pounds. He's not a member of BBPLC's occupational plan, but the bank contributed 5,000 into Basil's personal pension scheme of tax year. So first of all, we will do the basics that what we have done for the 2 of those persons above, which means I will just do the same story as above. The annual allowance charge comes into play in the most last. When the liability computations comes into play, there the allowance comes in. Till then, you have to still work that amount and extend the band limits by that. It should not create any hurdle in between. So continue to do the same work as we have been doing for all those persons involved in. This person contributes by himself what? 60,000. He has been participating in tax year 24-25, which is a gross participation. The level of earning that this person has is 262,000 employment income. We have to take the highest of 2. And the highest of 2 this time is definitely 260,000. Selection is based upon by picking the lowest of 2. Lowest of 2. And we have selected. With this, the band limits will extend 37700 plus 60,000, 125,140 plus 60,000. This is 97700. This is 185,140. Once the band limits are extended, we will go to calculate the liability based on to it. This is the level of income that this person has. And this requires to be reduced with the effect of personal allowance. The personal allowance will come in, not come in, we will see. So for this reason, I feel it like the personal allowance will not come in. And I can once again prove this for now, although I have shown to all of you this calculation a while ago. ANI has to be more than 200,000, which in this case is happening or not. Which is ANI? Total net income minus gross participation, which in this case is, oh, sorry, this is 262. I thought this is 260. Well, you could have corrected me. Any one of you could have corrected me that the figure that I've punched it is 262 instead of 260,000. So the level of income becomes too big that gross PPS, we will have to come and subtract. Gross PPS is 60,000, sorry. By himself, 60,000 is what he has been participating. So ANI has turned out to be 260,000. sorry, 20200. That when I will go to achieve that reduction into the personal allowance, it's gonna be too huge. 20200 minus 100,000. That's the reason why I did take no allowance over here. That process several odd times we have revised in the past, and still we are revising and revising and revising. Okay with that? Now, computing the liability, the band limits are extended. So I will go to tax up to 97700 mark. Up to 97700 at the rate of 10%. At the rate of 20%. I guess the level of income has touched the third band. Yeah. So in between 185, 140, 185, 140 minus 97700, the gap is 87440. 87440. That will be taxed at 40%. Excess will be taxed at 45%. What is going to be an excess? So it's 97700 plus 87440 minus 262,000. That's going to be 76860. 76860. 76860. 34587. 34587. 87440. 34967. 97700. So far you can clearly see there is no annual allowance thing has into it. This confirms to all of you that the annual allowance will come into the last part of the question. Till then, you have to do the same thing that you have done it with other employees. First, you have determined the amount by using this way of doing. And then once the amount was determined, you came to extend the band limits by that. Once the band limits are extended, even the liability computations have been performed the way that normally we perform. After we are done performing that liability, there the annual allowance will come in. And there I will go to make the use of this knowledge for the very first time. In this question, I will copy and paste this whole talk so that I can bring it onto that page in a continuation. So annual allowance charge arises when the amount of contribution that both of them, their participation goes more than 10. So the participation of the individual in this is 60,000. This is what an individual participates. Or you can say that employee participates 60,000 and employer participates on his behalf 5,000. Check this out. 5,000 participate. So total participation is 65,000 combined, which is going past to that mark of 60. Excess becomes 5,000 and this excess is going to be taxed over here at the same rate currently he pays the tax. This is called as annual allowance charge. So the mechanism is explained to you, but this limit needs to be revised because I also have to come and make the use of that knowledge where the 60,000 is going to be revised. But if this, suppose 60,000 is not revised, then we just have to find the combined amount of participation, which is 60,000 for myself and 5,000 by my company on my behalf. Total combined effect is 65. By how far this goes past 60,000? 5,000. This is going to be taxed at the rate of 45%. This is called as annual allowance charge. But we have to play with this limit. On the next page on the top, I'm going to revise this limit in two legs. The first leg is the same, where I have to see if the net income goes past the 260 mark, which in this case might gonna happen or might not. And then we also have to take this unused annual allowance from previous three tax years. Let's go one by one. Let's concentrate onto this side. The net income, the formula for the net income is the total net income plus the gross PPS by an employer. This is 267,000. How did I get this one out? 267,000. This is 267,000. Now, how this figure has been arrived at 60,000, 260,000 is the level of net income that employee has, plus the gross PPS by employer. This is how the way that this 267,000 has arrived at. This is PPS by employer. This is net income. It's called as adjusted net income for the topic of pension, adjusted net income. So the limit is 60,000. And we will have to make the use of this formula that takes the adjusted net income minus 260,000. And then we go and take a 50% of it. Then we will go and take a 50% of it. So 7,000, the half of that is 35. This takes the limit down to 56500. This takes the limit down to 56500. 56500. So the limit has been stripped down to 56500. So just don't write the net income. Top this up with the gross PPS by an employer to make it adjusted. Once this income has been found out to be an adjusted one, make the use of this formula. Adjusted net income minus the limit multiplied by the 50%, bring it down to 56500. So this limit already has been squeezed down to 56500. Now I have to come down to that side to see what I can take it further from. And this calculation, I can do that on the next page, just to be more and more transparent about. I'm into tax year 24-25. So last three tax years are 23-24, 22-23, and 21-22. There I can write down the figure of gross contributions. There I can write down the figure of unused annual allowance. So let's copy and paste their contributions for each of the tax years, 30,000 for the first one. The next two tax years, they have been participating 40,000. No. Also, for your information, you have to keep in this mind that the annual allowance limit for the recent tax year is 60,000. And before, we have to assume it as 40,000. Limits. These limits will be available to us in exam hall, but still you can remember it. 60,000 is the limit for the recent most tax year, and then before than that, it was 40,000. So the contributions were 30,000. This will come to exhaust the 40,000 by 30. So what portion of the 40,000 was not used is 10,000. They're fully exhausted. What portion of 60,000 has been exhausted? 40. What has not been? 20. That means we can come to This is that unused part which can go down to tax year 24-25 to top up into that tax year's annual allowance. So I can come down to write the answer of this side to be as final 30,000 because that's the one we are carrying it forward to 24-25 tax year, which means when 30,000 will join in the 56500, the total of that is gonna be 86500. This is the limit that has gone up to. I can now rub this one off. Originally, it was 60,000. But now I can go to enhance it to 86500. And the calculation of that is all here. That how did we get this much and that much? How extensively this question has covered every bit of that from the topic of pension. And when we've realized that the contributions have been found out to be less than 2, no annual allowance charge will arise. According to original 60, it could have, but now when the limits have been revised, it cannot be. Okay with that? Have you seen it? Is there anything being left from the topic of pension that this question has not offered? 3 persons were involved. This process I have applied for every person. Amount calculation, extension of band, computing the liability. For 3 persons, this process was that one uniform thing. Yes, for the basil, we have come to apply the knowledge of annual allowance charge. Process, I have explained that to you. That look, the combined participations, when they are in excess over to 60,000 pound, excess becomes chargeable either at 20% rate, 40% rate, 45%, all depends upon at what rate that person currently pays the tax at. Then we came to revise the limit of 60,000 in 2 legs. The first leg was this. Net income adjusted one is more than to 260,000 pound. We go and reduce the 60,000 pound limit by the process has been shown to all of you. The second leg of the revision is to top this up with unused portion of the allowance from the previous 3 tax years. That is the whole detailed talk about it. The total limit turned out to be 86,500, which obviously the combined participations were never going up to that. So an annual allowance charge in that case now will not arise. Seen it? This pretty much ends the journey of income tax, which is the most significant section of the course of ours. And so we have spent the majority time of the revision of ours on income tax. This allows us to now take ourselves down to the next area of the course, the capital gains tax, which we will start it off today and will continue the same into the third leg of the revision, which is planned to happen tomorrow as per the time and the date that we have announced. But we are not going anywhere. We still have got 30 more minutes or maybe some more time to spend on, since I started the course with a delay of 30 minutes, considering the fact that the most of you can participate in after the long day of work. So we will also have to extend it by like 30 minutes to fit in the schedule. Otherwise, we won't be able to finish all what we have planned to revise this way. So we are heading towards to the income tax, capital gains tax, after we are done completing ourselves on income tax. Such a beautiful question. In order to revise the topic of pension, this one question can do everything. In order to revise the losses, these 2 questions can do everything. Partnership, this question has made it enough what needs to be done in the topic of pensions. And so is the case with some other questions we have done. That's the best that in a short form revision course one can think of planning to work, and we are. Capital gains tax. Capital gains tax is a topic which is testable in exam in section B of the exam for 10 marks, and then couple of objective test questions into section A. Roughly, on average, you keep it in mind that the capital gains tax topic is going to be examined for like 15 marks in the entire exam. And for those 15 marks, again, we will have to work 5 questions, out of which 2 of those will cover the side of company, 3 of them will cover the side of individuals. We can start ourselves with the very first one, the name of which one is Alice Lim. The questions of capital gains are quickly to solve. They're not as extensive as the income tax questions were. So in a less amount of time, we can solve many. Starting myself with the very first one, Alice Lim. And see, this question comes to bring in straight away 2 reliefs, rollover, gift, holdover, and an interspouse, no gain, no loss, transfer. Yeah. Alice Lim, page 36. This one. This question has been adapted according to the Finance Act 2024. They want us to calculate the chargeable gains arising from Alice disposal during the tax year 24-25. Alex is a higher taxpayer. There were in fact 4 parts in it. I have removed the part B out of it because that thing that was tested in actually in is no longer exist in the course of taxation. So that part has been removed. Alice has made the following disposals during the tax year 24-25. First one, the part A of it. Let's see what this focus on. On 24th of June 2024, Alice sold a freehold office building for £152,000. Office building is a qualifying asset. That is a day of disposal. The office building has been purchased in the past for 134,000. The cost is given, the date of purchase is given. Prior to this, Alice had sold the freehold warehouse for 149,000, making a gain of 56,000. Alice made the claim to roll over the gain arising on the disposal of the warehouse against the cost of office building. Both the office building and the warehouse were entirely used for the purpose of businesses in the manufacturing business run by the Alice as a sole trader. This question is totally focusing on roll over relief. And I will take this moment to revise it. That so many times in the courses we've done this rollover relief, and we'll take this moment to revise this for one more time. We have to see what happens first. This is an event which has happened earlier on. They say that prior to this, Alice had sold a freehold warehouse for 149,000. So we have to respect what happened first and then we will go back to this one after. So freehold warehouse being disposed first. Let me go and title it. Freehold warehouse. The day it was being disposed, the day was 15th of April 2013. 15th of April 2013. And the proceeds of the disposal were 149,000. And the gain 56,000. The cost can be found out to be as a balancing one, which is not really required, but if we can work, not a big deal. 56,000 minus 149,000. The figure has to be 93,000. The figure has to be 93,000. Now, they are going to buy an office building, an office building, an office building, the cost of which one is 149,000. Sorry, 134,000. My bad. And the date of investment is 2nd of March 2030. Now, the asset, the one that they have disposed and the one that they are purchasing, both are qualifying because they are office building and warehouse, business, land and building. These are qualifying period of investment 1 year before, 3 years after. So 1 year before and 3 years after. 1 year before and 3 years after. So if you look into that, 3 years after, the date is going to be 14th of April 2016. A year before, it's 16th of April 2012. 1 year before and 3 years after. 1 year before and 3 years after. 1 year before and 3 years after, the investment must have to take place, which definitely is taking place in a year before. So provided the criteria is checked, provided the criteria is being revised to all of you, that the one that they have purchased, the one that they have disposed, both must have been qualifying. Investment must have to take place in these 4 years, 1 year before, 3 years after the date of disposal. Did they make the full amount? No. Have they invested the full amount into it? No, does not seem to me. So what they have not investment will become chargeable instantly. So what have they not invested? 15,000 will become chargeable instantly. And the balancing will be deferred. That's gonna be 41,000. So I will have to come and subtract that amount with the idea of getting the base cost. The base cost is gonna be 41 minus 134. It's 34 minus 7, 93,000. This is the base cost of this office building, which they later then came to sell on 24th of June 2024. $152,000. I will be using that base cost to get me an answer, and upon which this first part of that story has come to its end. 52 minus 7, that's going to be 59,000. Provided the calculations have not been an issue, that's the end of this first part. Base cost is what we come to use it later on for the purpose of computing the gain. That is what we have done. So we started off with this discussion first, because that has happened in the past first. The proceeds were invested in office building. The amount that was not invested in, that became chargeable immediately. The balancing figures deferred, deducted that out from the cost to find the base cost, which later we have used it upon the eventual disposal of this asset to calculate the gain based on it. Okay with that? So rollover relief will come to our way even in some other questions afterward. The case would have been much simpler if the whole amount was reinvested. But good that we have seen a case where they have invested the part of it, and what they have not invested became chargeable instantly. Okay with that. Then comes the part B, which let's see is focusing on gift holdover relief. On 27th of Feb, Ellis sold the 40,000 shares in a family limited for 230,000. Alice has acquired the shares on 21st of May when she purchased them from her mother for £122,000. So these shares were acquired in the past from her mother for £120,000. So they are now telling us the whole history, that from where these shares have come from. Alice's mother had originally purchased the shares on 19th of December for 128,000. Now they are telling the history that the mother has purchased these shares in the past from where Alice and her mother elected to hold over the gain arising on 21st of May. So now both of them, the mother and the daughter, they are making an election to hold over the gain as a gift of asset. The market value of the shares on that day was 168,000. So again, we will start off with the mother first because this party comes first. She is the one owning the shares originally, and she comes to gift those shares to her daughter. The name of the daughter is Alice. Yeah. There has been the shares gift. What is the date the shares were gifted to? 12th of May 2014. 12th of May 2014. Well, the cost is given as what? Alice's mother had originally purchased the shares for 128,000 in the past. Market value on the date was 168,000. So this is the gain that at least we have been able to work onto a side of a mother. The proceeds in the books of seller turns out to be a cost in the books of the buyer, which is 168,000. Proceeds in the books of seller turns out to be a cost in the books of buyer. As we are writing it out to be the balance of proceeds in the books of seller, turning it out to be a cost in the books of the buyer. Noticeably, the market value of the shares on that day was 168,000. And she comes to compensate her mother 128,000. She purchased them from her mother for 128,000. So this is going to be a cash proceeds in it. 128,000. Then what must have been a gift element in it? 40,000. What must have been the gift element in it? 40,000. What must have been a gift element in it? 40,000. This is called as partial gift, where the donee comes to compensate part of it, not the whole part of it. This has been the value of the shares, but she has been able to pay 128. The part that she has not paid is called as a gift, partial gift. So now we will have to concentrate on the balance of cash proceeds and the cost of these shares. No, the cash proceeds were 120,000. Is it? The cash proceeds are 120,000. 120,000. And the gift element of that is going to be 48,000. So we have to concentrate on the cash proceeds from the one side and the cost on the other end. We have to see by how far the cost, the cash proceeds are over and above too. Because anything that will go over and above will become chargeable instantly. The balancing of that amount will be holdover. Balancing of that amount will be holdover. So we will have to see by how far the proceeds are over and above the cost, which definitely is not the case. Proceeds are over and above the cost, which definitely is not the case. So nothing will be charged. And the balancing of that amount will all be holdover, which will go to bring the cost of the shares down to 128,000. Tomorrow, when she comes to sell these shares to someone, which she is doing on 27th of Feb, she will go to make the use of that cost upon the eventual disposal, which is 27th of Feb, 2025. The proceeds of the disposal are to 30,000. And the cost that we are going to subtract is going to be 128,000. So 230 minus 128, the figure turns out to be 72,102,000. This is the gain that we have got, 102,000. Okay with that? But this is the answer that we have got. So holdover relief. This question is such a good one that in one part you people have seen me revising the rollover, and now in the second part you people have seen me revising the holdover relief, the gift holdover relief. The concentration has to be on to see by how far the proceeds are in excess over to a cost. So if the proceeds are not in excess over to, nothing will be charged, because excess equals to a gain. When nothing is in excess over to, nothing will be charged. All the figure is deferred. And the process of finding the base cost remains to be the same. We will use that amount to record the disposal later on, which we have done. The part D of it is focusing on inter-spouse no gain, no loss transfers. So on 1st of March, Ellis sold a house for 180,000 pounds. The property had been purchased on 1st of April 2005 for 50,000 by Ellis' husband. He transferred the property to Ellis on 1st of April 2009 when it was valued 80,000 pounds. The house has always been rented out to tenants. Always been rented out to tenants. Okay, so I will start with the previous thing first. Originally, who was the owner of this house? It was the Ellis husband. So I will start off writing it, the word husband. He was the original owner of the house. Alice is the lady to whom this house has been sold out to on the day. The day is 1st of April 2009. The cost is given as 50,000. And the market value on the date of transfer was 80,000. And this is the gain that we have ended up working. The proceeds in the books of seller turns out to be a cost in the books of buyer. But because these two persons are not just the two random persons, a couple, spouses of the married couple, so transaction has to be at no gain, no loss. To have no gain, no loss, the balance of proceeds will be the cost itself, which will turn out to be even a base cost for buyer. And tomorrow, when she goes to sell this up to someone else, which she is up to selling on 1st of March 2025, she will be able to use that cost to calculate the gains based on to it. The proceeds of the disposal are 50,000. And the cost that we are going to use is the one that now her record suggests. That is it. So this is how the way the inter-spouse gain loss transfers are treated. Whenever they are going to transfer the assets in between, the transaction is always considered to be as no gain, no loss. And how to achieve it? Use the cost and make the assumption the proceeds to be the same as cost. So that 50 minus 50 equals to 0. When this assumption has been made onto the side of husband to be as a balance of sale proceed, that will continue to be the cost on the side of the buyer. So tomorrow when Alice will go to sell it to someone else, she will go to use the same cost to calculate the gain on her side. The job's pretty much done. Three issues in that one question we have highlighted: rollover relief, holdover relief, and interspouse no gain loss transfer. We will take the question name building, because I believe that this is the question that we can fix it in the time that we are left. The David and Angela group can take some more time. We can complete this building like in 20 next minutes to wrap up the second leg of revision. Another question on capital gains, which we'll go to bring in some more reliefs. Calculate the gains arising and the capital gains tax liability for Bill and Belle on the gift of High Rise Limited shares to Belle and subsequent sale of Belle. Assuming that Bill and Belle make the joint claim for the gift holder relief and state the due date for the claim. Yeah, so this question once again will require us to make the use of the relief. And then we will see what do they demand from us in the part B and C. We will see. The building has run a construction company. The name of that one is High Rise. Since he purchased the entire shareholding for 112,000 in 2004, that's the cost that he has incurred in buying. He has worked for a company since purchase, decided to retire on this date, and made a gift of his entire hold of High Shares Limited to his daughter. So this is a gift of shares to daughter. Belle is a name of a daughter. Bill is a father. Belle, who works for a company, market value of the shares on that day was 260. So this has been the market value of the shares on the date of gift. So looks to me right now a simple story. This is the shares have been purchased by the Bill in the past for this much of cost. When he comes to give this off to his daughter, the market value of the shares on that day were 260,000. On 17th of August, the day the gift was made, the market value of the high risk chargeable assets were 180,000. Of which 150 was in respect of chargeable business assets. Both of them, they have made the election to hold over the gain on the gift of business asset. Belle then in turn plans to sell the shares on 31st of March when they are expected to be worth 260,000. Neither the Bill nor the Belle has made any previous disposals to the capital gains tax, and both of them, they are the higher tax payers. So that's it. Looks to me like a very simple question. They have tested us on mainly the gift relief. But the gift relief that we will go to apply over here will be different, because this gift is a gift of shares, and in relation to shares, the gains are rolled over in a different manner, not the manner that we have seen in the Alice and mother case. So two parties are involved. We'll start off with the bill first, and we are solving the part A. So I will first of all name the party Bill. Bill is a father, and then Belle will come after. This is Bill, and this is Belle. And he is gifting all of his shares to her daughter. On which date? 17th of August 2024. These shares were acquired by Bill in the past for 112,000, and the market value on the date the shares were gifted was 260,000. So I came to work the gain in the first place so easily. 260 minus 110. It's going to be 260,000 minus 110,000. It's 148,000. 148,000. The cost in the books of Belle will be 260,000. Now, this is what we will have to try and hold over. And there is a way of doing it. The way is you take the amount of the gain which in this case is 148,000. You take the amount of the gain multiplied by the chargeable business asset divided by chargeable asset. So chargeable business assets are 150,000. Chargeable business is 180,000. So 150 divided by 180 multiplied by 148,000. 123,333. 123,333. This is the gain that we will be able to assess after to that. It's 24667. 24667. 24667. So to find the base cost, I will have to subtract 12333. So the base cost has been worked. We're done with the side of the bill, but they want us to calculate the liability. If I look into the case of bill, you have to understand, and we will have to bring in the effect of one relief in it. See, when the shares are gifted, where it attracts the gift holdover relief, on the other side, it may also attract business asset disposal relief. Business asset disposal relief is applied when the shares are gifted, provided the shares are the hold in the company that you hold the shares in, your hold has to be by 5% or more. At least 5% means 5% or more. Secondly, you must have been working for that company. Shares can be quoted, unquoted, does not really matter. At least you have to have a hold of 5% or more. And secondly, you work for a company. So Bill has been working for a company. And entire shareholding. Third and the last condition is that you must have to have an ownership over to such by 2 years or more. Back in 2004, this investment was done. 2-year rule is definitely satisfied. So this gain is going to be attracted to BADR. Gains eligible for BADR. So I will have to come and subtract an annual exemption. And we'll go to apply the BADR over 2, which means I will have to tax these gains at the rate of 10%, up to 1 million pound. This, how the way on the way, another relief in the same question will be applied. It's 21667. Capital gains tax liability at the rate of 10% will become 2167. Because we have applied the business asset disposal relief over here, BADR, business asset disposal relief, 2167. Otherwise, this person is a high taxpayer. I would have definitely applied 20%. But because we have applied BADR, why? Because the person has been working for a company, owns the shares by more than 5%, ownership more than 2 years. So the gains that we are left out with will become eligible for BADR, which means we will have to tax those gains at the rate of 10%, which I did. Then the Belle will go to sell these shares to someone. We will go to work this disposal thing on the next page on the top. Planning to sell the shares on 31st of March 2025. The proceeds of the disposal are going to be 262,000 because that's what the market value they're expecting to sell. And the cost that she is going to use is the one that the record suggests, 136667. 13,777. So this is the gain that we have ended up working. Now, will this go to attract any relief? Let's bring in the top. This is 125. And then we will go to subtract the effect of annual exemption. This is the disposal of shares, so it won't attract any gift relief. She is planning to sell the shares for 262,000. I will go to make the use of annual exemption, which will take the whole of the gain down to where? 1, 2, 5, 333. 1, 2, 5, 333 minus 3,000. It's 1, 2, 2, 333. Can we go to apply BADR over to it? She has become an owner of these shares on 17th of August, and she did come to sell in a matter of few months. So ownership rule is not satisfied, although she works for a company. Yeah, she also works for a company. I see that was written somewhere. Yeah, Belle, who works for a company, she will have a hold of 5% or more because entire shareholding has been gifted to her. So she holds 100% of an interest in a company. She works for a company, but the only trouble is that the ownership is not going to satisfy. She has become the owner of these shares on August 24, and she did come to sell this out in a matter of few months. So BADR won't be applied. When I will go to work the capital gains tax liability for this lady, it will be at the rate. And because she is a higher taxpayer, I will have to use 20% rate of tax to tax the liability. This is the end of the first part of this question. 24467. 24467. Yeah. Calculate the gain arising and the capital gains tax liability for Bill and Belle on the gift of higher limited shares to Belle and then subsequent sale. Yeah. That is the end of the part A. They were wanting me to include the reliefs and state the due date for this claim. For due date for holdover relief, the due date is 4 years by the end of the tax year of gift. So this is the tax year of gift, 24-25. And the claim date of that 4 years by the end of the tax year of the gift, that's going to be this date. This way, you will get simple marks of writing the claim dates. 1 mark was attached to it. So if you will go to write this one out, you will get that 1 mark. So I've always emphasized on learning these claim dates and deadlines during the courses, and I did spend time onto that. Recalculate the gains. Why? For both, assuming the joint claim for the holdover is not made. So I will have to copy and paste the entire story, but I will exclude the gift relief from that. And probably the last part requires us to conclude by the calculation of saving on which route would be preferable. So part C depends on the part A and B. Part A we already have done, and now we are about to work the part B. In part B, we have to make an assumption the gift relief has not been claimed. So let me do a bit of an editing. Claim date, I do not have to write because we are not claiming the gift relief. This I need to rub off. The gains will remain to be the same. This will go and shift it up to that part. BADR will still be available. 145,000. At the rate of 10%, the figure will turn out to be 14500. The base cost will remain to be the same as its original cost. And then I will also have to come and copy and paste this on the next page. I will use now the actual cost, which is 260,000 instead of two. This will work the gain of just about 2,000, and the annual exemption of 2,000 will go to exhaust. That means no gains in the end when we have no tax liability to be paid. How easy is that for me to solve the part B? And now we just have to come and conclude by taking the next page out. I will make the table of taxes. There I will write the name bill, and there I will write the name of the daughter, and under the banner of both, here I will write the capital gains tax liability, CGT liability. In fact, column wise, I can write the part A, and here I can write the part B. And here I can write the persons, the bill and the ballet. And then we also can write the full total effect. So if I go and look into a part A, what is the liability the bill has ended up paying? 2167. It's like a grid. What is the liability the ballet was paying in the part A? 24467. 24467, and the total tax is gonna be 24467. 24467 plus 2167. It's 26634. For the part B, the bill was ended up paying 14500, and there was no liability that the ballet was supposed to pay. Now you can make a conclusion which option is a preferred one. Definitely this one, because this has resulted into a less payment of tax by both as combined. Yeah, if you look from the perspective of bill, he will prefer to go with part A, means he will prefer to obtain the gift holdover relief because this will result him paying less tax. If he goes with the part B, he will end up paying more tax. But as far as the balance perspective is concerned, she will opt for the part B because she has ended up paying no tax if he goes with. But overall, preferred option is option B because this will save the tax for both overall. And that what this part was requiring us to comment. By making a table of this, your conclusion will exactly be spot on based onto it. So this part question, like I was like, could have solved it based on to the time that we have, and we have solved it. And this way the release will come into your questions. And if you have mastered the knowledge that has been given to you back into courses, these questions are easy to work. These questions are just to practice and to gain a confidence, right? The way that in front of all of you I have done. Held over relief first, and then the business asset disposal relief to end with. Criteria has to be kept in mind. No one is telling you in this question to apply BADR. Did I? Do you see somewhere else they have given us any clue that says that the BADR you have to apply? Yes, because the question involves a gift of shares. So generally, the one thing that will come into your mind is the gift holdover relief, which they are also demanding you, explicitly asking you to apply. But the one relief that I have applied into it by myself is a BADR because I know that when the shares are gifted or sold, provided you have a hold of 5% or more in that company, provided you work for that company, provided the ownership is 2 years or more, the gains, they become eligible for BADR, which makes them to tax them at 10% up to 1 million pound of gains. So I did. For Ballet, it could have not been the case. Ballet still owns the 5% or more. Ballet works for a company, but Ballet does not have an ownership of 2 years or more. So the Ballet was ended up paying 20% rate of tax, being a higher taxpayer. While in Part B, I still have applied the BADR to bill, but I have excluded the gift holdover relief because they wanted me to do that. And then Part C was the one in which the conclusion was made. Is it that difficult to answer the question of this kind? You see, this question carries 10 marks. This is a question 4 of text exam. Section C. Remember, section C has 3 questions. First question has 10 marks. The next two have got 15 marks each. But this question is for 10 marks. That's question number 4. That takes 10 marks. And if you have to work the question on a spreadsheet, how easy is that to work on a spreadsheet? Literally, you have to punch in the figures into cells with these typing stuff on the left-hand side. Okay with that? So nicely, the way the whole of this revision task is going on, the second leg of this has come to its end, and according to the plan, we are really up to the mark. We're not lagging behind. We're completing, and based on whatever was planned into my mind, we're finishing. And I'm still being patient on explaining each thing. We started the second leg of the revision today from the partnership question. Remember the time spent on that question of partnership today. Allocation of profit. I was focusing a lot on months calculation. Then we gradually got into the talk of trading losses. Samantha was the first one in which I did cover 3 types of losses. And Michael and Sean was the second one I did cover the remaining 2 types of losses. Pensions. Entire topic of pension has been revised in Enclo, Basel, and Plum. Annual allowance charge, OPS, PPS, extension of bands, and all. Capital gains, finally, we've got into. Rollover relief has been touched. Gift holder relief has been touched. Inter-spouse exemption has been touched. Business asset disposal relief has been touched in. Well, basic computations anyone can do, sale minus cost, annual exemption. There is one more question we have to work on, which will come to bring in the PPR relief, letting relief. That question is David and Angela Bro. So like I said to you, these questions being picked out with the aim of touching everything. And then not to forget, we have to look into the capital gain side of companies. The indexation allowance calculation will come into play in these questions. Share pool, index cost and all. 2 questions from the company side we will work. The one is Luna Limited, the other one is Hawk Limited. This one is a section C type question. This one is a section B type question. And after that, then we will be able to step ourselves into inheritance tax. This is all planned for tomorrow. Tomorrow, we will expect to finish the capital gains. And then we will be expecting to finish the inheritance tax also. Can happen that in the last 30 minutes of the course, or maybe 1 hour of the course, we'll be able to start off with corporation tax, which will continue into the 4th leg of the revision course the day after. So all according to the plan, we are working it out. You people have been participating, keep on participating based on whatever the time that's being left. You know the time schedule, you know the time. I can still fix to start this with 6 p.m. tomorrow, because I have observed that most of you were made available by 6 p.m. in the evening, UAE time. So rather to start it at 5:30, I'll keep it for 6. Fine. So even tomorrow, although it has been announced to start at 5:30, but we keep it at 6, as you people are already informed about from today. Any one of you who have not joined me in, who was there in the first leg, try and make sure that you can watch it out from the recording, so that when the third leg of that will start, the next tomorrow, you can enjoy the continuity of it. It concludes the second leg of the revision course of taxation today. I will see you tomorrow to continue with this revision. Have a good rest. Have a good time. Thank you very much.